Managing money can be confusing, exhausting, and sometimes it's all just too hard. So we're here to make things as simple as possible. Here's 5 easy steps anyone can make to take control of their money and build a better financial future for you and your family. The first step is mapping out a budget. It sounds boring, but it's really important to take the time to sit down and see what you're doing with your money. Often it's not about your income or the money coming in, it's about expenses and the money going out. If you can actually see your spending staring right back there at you in a budget, it's easier to review your financial standing and see where you can make a few quick savings. Can you cut out that daily coffee and make one at home instead? Do you buy a few lunches per week and you can make those at home perhaps? Are you really using all those memberships and subscriptions that eat away at your bank balance each month? This doesn't really mean you have to cut back on absolutely everything, but knowledge is key here. Weigh up what gives you value in your life and give yourself a bit of a fresh start. The second step is to pay off any high interest debts as a priority. This is where you can begin to take back control of your finances. Some people can feel helpless if they're stuck paying off a balance on a credit card or a personal loan with interest rates sometimes as high as 20%. It can be really hard to make any progress here as you just end up paying on that interest and not the actual principal. Firstly, you need to take away that temptation and get rid of your credit card if you still have it. Now explore balance transfer promotions which give you 0% on a balance over a defined period. If you do decide to go down this road, however, you cannot use this card for any new spending as often they'll slug you with super high interest rates once again and you'll be back in the same spot. Instead, you need to use this interest-free period to chip away at your principal. Get yourself back on track, clear that debt without the extra layer of interest weighing you down. In this simple example, you can see how much of a difference a bit of effort can make in searching for a balance transfer promotion. If you had a $10,000 debt on a loan or a credit card, paying that 20% interest rate, and you're paying $100 per week off it, you'll pay an additional $2,647 over 2.5 year time period. That's over a quarter of the principal in just dead money. Instead, you could do a balance transfer to a 0% credit card promotion, pay the same debt with the same payment strategy of $100 per week, and you'll pay no additional interest and have the debt fully paid in 2 years. This comparison doesn't include any annual fees or any additional details like that, but it just shows you how a bit of research can help you get back on track if you have a high interest debt hanging over you. It's important to clear this type of debt because you'll never find any savings account and it's very difficult to find any sort of investment that will give you a guaranteed 20% return on your money. So by paying these sorts of high interest debts down, even if it's a 15% or an 18% loan, it's the best use of your money in the short term and a big relief to have that kind of debt off your shoulders. The next step is to build an emergency fund. This relates to the previous point of paying down high interest debt. If you have an emergency fund available, you should never have a reason to go looking for credit cards or personal loans again in the future, and you'll avoid falling into the high interest debt trap again. It's your comfy safety pillow. Look back to your budget you put together in step 1 and figure out how much you can comfortably save per week, per fortnight, per month, and set up an automatic transfer the day your pay packet arrives in your bank account. The trick here is what many call paying yourself first. That means setting up your finances so a portion of your money is automatically transferred from your bank account into a separate savings account before you even have a chance to touch it. You can easily set this up in 2 minutes online through your financial institution or even just using your smartphone sitting on the couch. And hey, some weeks you might have a bit of extra money laying around that you'd like to add to your emergency fund. That's all good. But the key point here is you do not touch this money in the short term unless it is a genuine emergency. We're talking a health crisis or some other unforeseen circumstance. Keep adding to this emergency fund until it's about 3 or 4 months worth of your living expenses. Again, this is where that budget you made in step 1 comes in really handy. The next step is to increase your superannuation contributions. Super is generally the most tax efficient way to save your money. There are government incentives in place to encourage people to prop up their super and save for retirement. Obviously, the catch is you aren't accessing this money until you actually retire. But it's still worthwhile to maximise these incentives to set you up for later life. Salary sacrificing straight from your pay packet means you won't even see the money in your account as it will be redirected to your super fund immediately. these payments are taxed at 15%. For most people, this will be lower than their marginal tax rate. So not only do you benefit because you pay less tax, you'll be boosting your retirement savings. You should note that the combined total of your employer and salary sacrifice contributions must not be more than $25,000 per financial year. So do some simple sums and work out the comfortable and optimal amount you should sacrifice to your super. Your employer would generally be paying a rate of 9.5% on your taxable income into your super. Even something small like an extra $50 or $100 a week can make a huge difference to your overall retirement fund. Let's do a little example. Say we have a 25-year-old on $75,000 per year with $10,000 already in super, and they receive just the standard 9.5% from their employer. By the time they're 67, they'll have a super balance of $533,814. By salary sacrificing just an additional $100 per week with the same level of fees and selection of investments, this same person could almost have $850 grand by the same age. That's a huge difference of over 300 grand, or an increase of almost 60%. This shows you the effect of time and compounding and how it can have a massive difference when it comes to your super, so every little bit counts. The last step is to save and invest. By now you have your debt under control and the basics covered, and you should be comfortable in building your own savings and considering your investment options. Again, it's good to go back to step one and plan things out in your budget so you can see what money you have available to save and invest. From here, it really is up to you what path you want to follow, as it entirely depends on your own circumstances and goals. Are you in the market for property? Do you have a taste for shares? Are you more risk averse and want to stick with high interest savings accounts or bonds? What about more speculative options like cryptocurrency? It's important to note you should still diversify across multiple assets no matter what you decide, and there's pros and cons to each. That's one for a later video, but by this stage you should now know at least you have the tools and the confidence to map out your financial future. So there you have it, 5 simple steps to financial freedom that anyone can follow. We'd love to hear your thoughts on these steps in the comments below, and please give us a like or subscribe if you enjoyed this video. Until next time.